Good afternoon, everybody. Welcome, welcome. Today is Wednesday, January 29th. This is our first quarter global markets and economic update. We are excited for the presentation. My colleague Brian and I will walk you through a number of slides. We start off with the why. So why do we host this event? Well, it's because we care. We care about you and we care about your financial plan and what you're looking to plan for the future. We host this event to highlight what's positive about the economy and, quite frankly, any negative components to the economy that are important to be aware of. And most importantly, we put the word here factual positive, and factual negative. So with that in mind, here's our agenda. We have an agenda for every meeting that we have, and you'll see we're highlighting the positive and negative for the US, international developed markets, the emerging markets, the more conservative part of the portfolio, the fixed income or the bonds. Then within the investment models, how are we implementing this data and factoring this in on your behalf? And then we'll open it up for Q&A. So we'll stop periodically through and I'll encourage you to ask your questions. I have my Q&A up on my other screen here. So if there's a question that comes to mind or we're in a certain section of the slide and you'd like us to elaborate, we can come back to it at the end and sort of unpack and revisit that part of the discussion as well. So let's jump right in. And I believe this part, Brian, I'm going to turn over to you.
All right, so we'll start off with here in the U.S. and start off with the positive, the good things that are going on. So first off, GDP continues to be in a positive direction. You see the trend growth is about 2.1%. For third quarter of 2024, we are at quarter over quarter, we are at 3.1. And year over year, we are 2.7. So we are still trending above, going above, the growth is still trending above the typical trend line. As seen on the right there, over 2/3 of the GDP is driven by the consumer. So the consumer is healthy and doing well. We'll cover a little bit more of that here in a bit. But everything is going well outside of really I guess we had 3+% quarter over quarter growth, with exception of I guess first quarter of last year was 1.6, but everything is trending well and things are still humming along in the US. This is a familiar slide. Really not a whole lot has changed. We still have more job openings than we have people looking for work. Since we last met, the number of job openings increased by about 50,000 or so. You see a little uptick there in the data. And then likewise, the people looking for work, it increased about 100,000 or 0.1 million. So really not a whole lot's changed over the last quarter since we last met. We've got about 1.2 million more job openings than we have people looking for work. Of course, the skill set may not match up, but at least jobs are plentiful, and that's looking well so far. And then further on the kind of the job fronts, more on the wage side, this graph here basically shows real wage growth, which is wage growth that you're seeing for those folks that are working with your paychecks, less the rate of inflation. So right now, over the last year or so, we've had about 2% real wage growth. So basically, your folks, what people are getting paid and what people are taking home is exceeding the inflation rate. Now, one thing of note, and Chris will talk about inflation rates here shortly, but like for folks that are retirees, the cost of living adjustment for going into 2025 was 2.5. So not quite as what working folks receive as far as growth is concerned, but it was still at least 2.5. And Chris, like I said, mentioned we'll be talking about inflation here in a second.
Okay, so what's bad? This will be my section here. So inflation, while this slide was in the good section earlier, we bumped it down into the bad in the sense that you see these diamonds here, these black diamonds. Overall, inflation has come down since its peak in the summer of 22 at 9.1%. You're seeing this increase here. The Federal Reserve is meeting today. Our opinion is that interest rates will not be lowered today. There's no good reason to lower interest rates today. So what you see part of this uptick is essentially from energy. So energy was contributing a lot to inflation here. Then it was, drawing it down, and the amount of energy's drawdown is faded in a sense. So as you see the energy prices rise, you see inflation rising. So this is something that we keep our eye on. We are not expecting interest rates to decline today, or the announcement would come tomorrow, and that's just fine. That's for good reason. Okay, so Brian highlighted the fact that there are more jobs available than people looking for work, which is rare throughout the history of our economy. What we also look at is payroll trends. So a good number that economists likes to see is an average payroll 3-month trend of 200,000. So you see we're slightly below that number. Here's the 200,000 job line. However, you see the payroll gain for December is at 256. So that's this blue line, and it was above in November. But October here was not a great month. So we're sort of, hovering along here. It's a little bit of both. Maybe a little Goldilocks, not too hot, not too cold, but this is something again that we look at, and we look to see this 3-month average trend above 200,000, and then we might even move it up into the positives. The other negative within the US, of course, as we all know, is our debt and our ongoing deficit. So we'll talk more about this through the presentation. Our debt to our growth, so GDP stands for the growth or the gross domestic production in the US. Those numbers are basically equal. So we are pretty much close to 100% of our deficit. Now, this stands for the Tax Cuts and Jobs Act. This tax law from the first time Trump was in office expires on December 31st of this year. So at some point during the year, this administration is going to shift towards tax law. We do expect this to be approved. And if that's the case, this is a chart from JP Morgan. JP Morgan is suggesting that our debt to GDP will grow even further than if we let the tax cuts expire. We'll talk more about how all this works, but certainly our debt and deficit is a negative as it relates to the US. Okay, other component, shifting back to the consumer. So we're seeing delinquencies increase. And down here you see auto loans, credit cards, student loans, and mortgages. Mortgages is a new one, and you're starting to see mortgage loan delinquencies. And so again, we host this so that as you're watching the news or you're seeing some highlight, you're not surprised by anything in particular. Student loans have pretty much leveled off, but you see historically they're in this range. Well, we're expecting this to increase as well once all the forgiveness is not the right word, but the pause, essentially the pauses are lifted and student loans need to start getting paid back. We expect these delinquencies to rise. Above here, it's given us, 45 years of history back to the 1980s. So You see overall 11.3 is a, below average number. But as we hear throughout, I don't know, 12, 24 months that consumer delinquencies are increasing, essentially it's not a surprise. We're aware of this trend. Okay, so let me summarize. In the US is doing well. We are growing. GDP increased by 3.1%. Having more jobs than people looking for work is rare. And that's something that we continue to see and is exciting. Anytime you have wage growth ahead of inflation, that gives you a strong indication of the consumer. As Brian indicated, the consumer is 2/3 of our production. That's what drives the economy. So if people are still getting paid ahead of inflation, that's a good thing. Okay, now inflation has ticked up. Again, I'm repeating myself, but that the 2.9% is actually right in line with the 100-year average. And for the financial plans that we write for folks, we use a average annualized inflation rate of 3%. Talked about the job openings, debt to GDP, of course, is a concern. And then here again, household debt servicing, we expect that to continue to rise, unfortunately. Okay, shifting gears, Brian, let me turn this next section over to you.
All right, sounds good. And then just as a reminder for folks, as we go through here, if you've got any questions, just go ahead and input those into the Q&A box, and we'll loop back around to those questions at the end of the presentation. So shifting over outside the US, we're going to start off with the international developed markets and the positive feature factors. So right now, this is a chart showing the central rate policies of various countries or organizations. The Bank of England, BOE, which is in green there, very much like in the US, they've continued to decrease their funds rate. And then in the ECB, the European Central Bank, likewise, they've actually been a little bit more aggressive than the Bank of England, as you can see there by the what's represented in purple. And the dotted lines for all the rates are kind of the projections going off in the forward. And then towards the bottom, Bank of Japan, as we've kind of touched upon before, they were in kind of a different interest rate regime. They were very low, stayed low, didn't have a reason, any worries with inflation or anything else, any reason to raise rates, but they have started to increase their rates. But they basically took it from a negative percentage to not even reaching 0.5% so far. So no concerns there. This is a chart of the top 50 performing companies based on the all world country index, all country world index. You'll see here on the far right, 2024, what may surprise you, out of the top 50 companies, there's only 14 that are US based companies. The remainder of the companies are either from international developed markets or emerging markets. So the developed markets, with the exception of US, is represented by the darker gray, black area there. So you can see that a number of companies, I'm sorry, has risen, gosh, from over the last, since 2017. So really the past 7 years, it's at a higher rate. And historically, the average of non-US companies being of the was in the top 50 was 33, and we're about at the 36 mark right now. So just kind of shows the importance of remaining diversified, not only out within the US, but outside, more so outside the US. Here's again a look at the inflation factors of all the other developed. I mean, there's some other countries on here, but what's highlighted in yellow are the international ex-US, non-US developed market countries. And as you can see here, all of them are below 3%. Japan's at 2.9, and you'll see what you'll see there in the figures in red off to the right there. Those are the figures from last quarter. So Japan ticked down a little notch. United Kingdom ticked up a little bit to 2.6. So it's a kind of a mixed bag. Eurozone remained level as far as their CPI. So most countries remain level, ticked up a little bit, ticked down a little bit but overall, inflation's not a concern from a international developed market perspective. All of them have been remain below 3% and have been relatively stable. And likewise, for both the Eurozone and Japan, which is represented here by the dark blue and light blue lines, respectively, unemployment rate still remains. This chart here shows the employment rate over about just over a 16-year period. Both in the Eurozone as well as Japan, the unemployment rate is at a low over that period or very close to a low. So from an unemployment standpoint, jobs perspective, just like here in the US, from an international developed market perspective, things are still looking fairly stable and doing well.
Yeah. Okay. So I'm going to take this next section here. One of the concerns internationally is going to be tariffs. And so that's a lot of what we've been hearing. And this is a chart from JP Morgan showing the average tariff rate all the way back, almost 100 years to the 1930s. So the rates were much higher previously. And then you see they ticked up here from the last time Trump was in office, and they've come down a bit. This is where it's proposed to be. Some of this may just be positioning or influence. For example, we saw the deportation to Colombia and a couple of planes, and then they sent them back, and then Trump threatened tariffs, and all of a sudden they're going to come and get them. So I think the threat of tariffs partially is meant to influence behavior. But I do partially think, I would think that some tariffs will go in place just so it's not all just hot air. And so with that in mind, these are our top trading partners. So Mexico, China, and Canada. So this is just my opinion. I would not be surprised if we saw some level of tariffs on Mexico and possibly Canada as well as China. So I think we'll see some here. The threat of tariffs elsewhere, I think, is just to mainly influence behavior. Speaking of influencing behavior, this is a Venn diagram of the globe. Essentially, wars, bad actors, so to speak, my view is I'm optimistic that these will decline. So you see the US here and our allies here. The bad actors are here: China, Russia, Iran, North Korea, and then the non-aligned countries. So we're seeing improvements between Israel and Hamas. And so optimistic that progress will be made in terms of all of these various global conflicts. So here's the summary. What's interesting about what's good, it's very similar to the US, but you see unemployment is low, inflation is low, which is why they're lowering interest rates. So the US is doing, international developed market is doing something similar to the US, and overall the economy there is good. And then the bad side, it's more of the possibility of bad. And I think of the influencing behavior. Influencing bad behavior is directionally where I'm seeing things, or worth seeing things go within the international developed side. Okay. Again, throw your questions in the Q&A. and we'll continue to plug along.
So transitioning now over to another piece of the international is international emerging markets. So emerging markets is still doing relatively well. And what this chart shows here is basically as we mentioned before, not only the US, but worldwide, the consumer drives the GDP of respective countries. And one of the things that's happening, especially within the emerging market countries, India, Indonesia, China, Brazil, Mexico, and a lot of other countries, especially in the Asia Pacific region, the emerging class is exponentially growing. So as you see on the chart on the right, this is a representation of the regional contribution, the emerging class, middle class growth projected over the next 5 years. As you can see by there, the Asia Pacific region is bounds above every place else. As you go to your right there, Middle East and North Africa, those are primarily all emerging markets, sub-Saharan Africa, as well as Central and South America. All those, granted, they're less going to see less growth within the middle class, but still they're on the positive side. And then on the far right, that's what we traditionally see as our international developed markets, both in North America, so of course, US, Canada, Mexico, or I'm sorry, primarily US and Canada, and then Europe, the Eurozone. They're actually going to see a decrease in the contribution to the middle class. So just some good trends as far as consumers and middle class folks that we're seeing within the emerging markets areas. And it really goes along with this. So this is a view of, this is right here is 15-year view as of through the end of 2023. But as you can see there, back in 2008, 15 years ago, the emerging markets of the percentage of the world GDP, emerging markets contribute 31%. Well, that's grown by 10% looking at through the end of 2023 to 41%. US grew a little bit from 23 to 27, and then the other international developed countries, actually their contribution to the world GDP decreased by about 14%. But this kind of shows you here that, in combination with what we saw previous slide, as well as some of the previous quarters, that emerging markets has grown by 10% for GDP, and we'll expect it to continue to grow and be an important part. So that's why when we do our investment, we do have a portion that's dedicated to emerging market countries. And from a negative side, there's really not a whole lot. I mean, we've got the ongoing military and trade conflicts. Now, granted, as Chris mentioned earlier, the situation with Israel and Hamas is kind of at least not escalated. It's gone to the positive side, or more positive side. So we've not seen a lot. I mean, we've still got the Russia-Ukraine situation going on, but there's not been, at least in the news lately. Now, it can always pop up, but there's not. It seems like things are de-escalating from a military side, and then mentioned earlier, trade conflicts, which may include some tariffs, that's still out there.
Okay, well, good. So I'm going to take us through the next section, which is the more conservative of the portfolio, which is the bonds, and in other terms, fixed income. This is a slide that highlights all the different types of bonds that a person can own. And the various colors here highlight how the bonds react to an interest rate change. So interest rates have risen over the past few years. They declined several times last year, and we're expecting interest rates to decline 2 times this year, and they would go down by 0.25%. Again, I'm not expecting it to happen today, and as they meet every 6 weeks. So the Federal Reserve meets 10 times per year, and we'll continue to update y'all as we host this call. So for the most part, if we just look at this light blue, no change throughout these different areas, you'll notice that the interest rates are pretty good. So 5.2, 7.2, 5.3, and this interest rate, it's called a coupon. So when you used to buy a bond, you would go to the bank and they would hand you this certificate, and they were perforated edges, and you would clip the coupon essentially and go in, and then you would get your payment. So that's where the term clipping the coupon comes in. So we're not expecting much to happen. And if anything, maybe half of this 1% decrease. So we're going to expect to clip the coupons that we have and possibly even see some appreciation with decreasing interest rates. This is another breakdown of something called yield to worst. What yield to worst means is that if you have a bond, and think of it like a CD, you have a 2-year CD or a 3-year CD, the yield to the worst would be how much interest you can collect between the time that you have it now and its maturity. Or another metric is something when the issuer calls it away. So it gives the issuer the option to buy it back if they want to do that. So, for example, we own U.S. Treasuries. These are the interest rates that you're seeing. Investment grade corporate is here. Mortgage-backed securities right here. Additionally, we have positions on the far right side, leverage loans. This is the interest we're seeing here, as well as a U.S. high yield. We do not hold any international bonds, and that's by design. And so as we look at all these components and the bonds, we're evaluating where we should be positioned. Okay, so what's bad about high interest rates and clipping coupons? Well, when you're issuing bonds like our government is, the interest that we have to pay, the debt service, I call it the mortgage, like the mortgage that we have to pay on our debt, on our deficit has grown. So right now it's 14% of the budget, and our net interest, our mortgage, is $952 billion. Our total spending for this year is $7 trillion. And you see that's broken down between, so for example, Social Security, Medicare, Medicaid, other mandatory are government and like military pensions. So what, 38, 40, over 50% of the budget is in Social Security, Medicare, Medicaid, and pensions. We've got defense. We have arguably the best defense in the entire world. And then this non-defense discretionary, this is where the Department of Government Efficiency, I think, is coming in. They're looking to cut, $1 trillion. And so you see our deficit here, 1.8, or roughly $2 trillion. They're looking to cut some of that out. And so here are the tariffs. Tariffs are 80 billion that are being suggested that we're going to implement. That's 1% of the budget. So for all of the, I don't know, discussion around tariffs, it doesn't influence that much in terms of contributing towards the deficit. So what this administration is trying to do is lower taxes to essentially grow the economy. If we grow the economy faster, we will collect more tax revenue. So, for example, the income taxes are on individuals, payroll taxes from corporations through payroll, and then the corporate taxes on corporations directly. So we'll see if they're able to do that, but that's their intention, is to try to lower taxes to grow the economy and resulting in a lower deficit. We'll see if that happens. So here's the summary. Since our last call, the Federal Reserve decreased interest rates in November and again in December. So we're not expecting that to happen for some time now, especially because of inflation, like we talked about. However, we are in a higher interest rate environment. So we're just going to continue to clip the coupon and collect that nice interest. And again, what's bad, I'm repeating myself now, is the fact that our cost to borrow is higher. I guess I will say the one other thing I didn't mention is that as interest rates decline, we basically refinance our mortgage on the debt. And so that percentage will go down as interest rates go down. Okay. Brian, let me turn this section over to you.
So this is kind of wrap up a little bit of some things. So this is how we applying this data on your behalf. So as far as we'll look at the two areas within equities and fixed income. Fixed income, we're going to maintain the duration with risk within the risk models, and duration, just kind of a refresher. It's really a measure of the length of the maturity. So like if you have a 2-year CD, it's 2 years, and also duration also kind of measures the sensitivity to change in interest rates. So as you mentioned, or as you probably remember before, interest rates and maturity have kind of a seesaw relationship. As interest rates go down, the duration, I'm sorry, the uh, the return on those increase as the duration increases.
Mhm.
So we did do increase the duration in our risk models last quarter, but for this quarter, given the fact that we don't see any interest rate moves anytime here in the immediate, we're going to kind of maintain the everything status quo on the duration front.
Mhm.
With respect to equities, we're shifting a bit of the large U.S. large cap allocation, which is the biggest piece of our investment models, our risk models, to shift the allocation to have more broad company exposure, which in part will also decrease risk because the S&P itself um, has started, the top 10 companies in the S&P has increasingly become a larger percentage of the S&P 500 market, so to speak. We saw a little bit that when we had the little shock on Monday with respect to AI, where NVIDIA and some of the other big tech players came down, which impacted the S&P 500 by about 3%. So we're looking to shift the large cap allocation to have a more broad exposure, both on the growth as well as the value end. And we're putting a couple other things in place to help lessen any shock, which Chris will get into here shortly. Should there be any shock to the equity markets that we see in the upcoming year or so?
So, okay, food for thought. So a couple of pieces we want to leave you with as we look ahead to the year ahead. This is a chart from First Trust. It's showing you the S&P 500 from 1942 to the end of last year. This is the S&P 500. This is the Dow Jones. I'm just going to walk us through this section here because they're very, very similar. So in any given year, it's important for you to know, or for you to expect to see a 5% or more decline about 3 times in any given year. There's a saying that a lot of you may have heard me say before, which is the only time people are disappointed are when expectations are not met. So we are very communicative about what we should expect in terms of account balance declines, so that way you're not disappointed. From here, what is the possibility of a 10% more dip? Well, that's about every 16 months. Okay. When was the last time that happened? October of 2023. So 12 months, last October, another 6 months. So we may see some volatility in the first half of this year. Okay, well, let's keep going. Negative 15% or more about every 3 years. When was the last time we saw that? October of 2020 2. So in the second half of the year, it's not, an exact prescription, but it's important for you to know that we are prepared for some volatility this year. And if we see this, we're going to take action on your behalf. We did this a couple of times last year, specifically right before the middle of last year when growth was so much higher than value. We sold high and bought low. We did that deliberately. As we got to the fall, we knew interest rates were going to be declining. And as Brian indicated, we increased our duration because as interest rates decline, you see bond values rise. So if, or I should say when, we see a 10% or a 15% dip whenever that time comes, we're going to be taking action on your behalf, rebalancing the portfolio to sell high and buy low. Now, there's another saying, it's not where you start, it's where you finish. So just because we see a dip during the year of 10%, 15% or more, whatever it may be, is just that. It's only part of the year. And so what this chart is showing you, this is the intra-year decline versus the calendar year end, which is in blue. So the intra-year decline is in orange. So in any given year, you could see a dip 25, 34, 49, 34. So you see the numbers here. The years where the calendar year end was negative, you see here, this is 1981, 90, 94. Here's the last, or I should, tech meltdown, negative 10, 13. 2008 was a financial crisis, down 38%. 2015, here's the end of 2018, the last 3 months leading right up to Christmas Eve, this was a -6. When you get to the more recent years, so here's COVID, 2020. The market went down 34% actually in 30 days, and then it ended up 16. So between something like March 9th and the end of the year, 9 months, it did a full 50% in that time. 21, we had a dip of 5, ended up 27, negative. So 2022 was a tough year. We were down 25 and ended down 19, 23 down 10, ended up 24. Last year down 8, ended up 23. So like I said, we're wanting you to know that we have a plan for volatility, and we'll not be surprised if we see some negative returns through this year, and we'll be taking action on your behalf. Okay, these are our prepared comments. I see we've got 4 questions here, so we're going to start to work through these. As you have additional questions, please throw them in the Q&A. You can ask anonymously, and likely someone else has the same question. Okay, so why is the employment rate of 200,000 a good number? Seems arbitrary. So let me go back. Maybe that's a page 5 or so. Here. To answer this question, why is 200,000 a good number? I think it's probably just due to our sort of working population. Probably something to the effect of like graduating students. There's another slide that we were discussing earlier, which is about, where was this on the labor force participation rate? I had that. I wanted, because it ties into another question about the job gap that Paul has asked here. Where is our labor force participation, labor supply, 25? Okay, looking at this slide here, this is the labor force participation rate changes. So you see female age 25 to 54, and then males 25 to 54, and then 55 over. So let me make sure I'm answering the question. Kayla, I agree. It is a little bit of an arbitrary number. I guess it's sort of what these economists like to see is to just put a measure out there that if they're seeing an average of 200,000 a month, they feel that it's a good indication of a growing economy. So I agree. I guess
Yeah, it's really just it's a number of additions to the non-farm payrolls. So it's
I mean, I guess it's just an indicate. I see the point where you're saying it seems arbitrary, but I guess they're just based on the size of our economy or size of the population, size of corporations, that it's a metric that they said if it's above 200,000, we're growing. Like things are good within the job market. Um, okay, I'm gonna skip this one and then we're gonna come back to uh executive orders in a moment. So how do you explain the gap between job openings as it compares to job hiring? So we chatted about this early because we've had this trend for a while, which is that we've got 8.1 million jobs, we've got 6.9 million people looking for work, and so why why can't these people find a job? What's going on? And so that's where this other slide may be able to highlight further is that the age 55 and over, you see the labor force participation rate is essentially shrinking. So these folks are not being hired. They're having a tougher time. Whereas on the flip side, the male age 25, although you see a little dip here, female 25 to 54, you know, growing, trending in the right direction over these years. So that would be, is our education not keeping up? Are people not willing to perform these jobs? So I think what it is that these types of jobs are very specific types of jobs, and these types of workers may lack the skill to fill the positions. Brian, let me get your sort of initial reaction to the question.
yeah, I mean, I think it's kind of mentioned, it's kind of a probably more of a mismatch. It's really not changed a whole lot since last quarter as far as job openings, the differential between job openings and people looking for work. Um, so it's really more of a probably more of a skill mismatch. Um, and what jobs are available and what folks are available to do those jobs.
Okay. Let me go back up to the top. What impact could the executive orders around energy have on the markets? So my view on this is, interestingly, previously under the Trump administration, he's very pro energy and drill baby drill. Well, anytime you have a larger supply of anything, you have the price go down. So I can see the price of energy going down, but here we are in Houston. Anytime the price of energy goes down, that puts more pressure on the energy companies. So they don't do as well when the price of energy is down. So it's almost like it's an interesting dichotomy that when you have um, a policy around, hey, drill baby drill, it's actually going to lower some of the profits of our energy companies. Brian, what are your thoughts here?
Yeah, but there's also been, I mean, I know, I guess the what was the withdrawal from the Paris Accord and stuff. So I mean, it's been the emphasis. I know they've looking at as far as utilizing or taking advantage of the Alaska resources. It's going more towards the less towards the I guess new energy, electric vehicles and all that, and going back to more of the carbon side of things. One thing that of note, like last year, or under the previous regime, like our energy reserves or natural energy reserves were depleted to help control the pricing. So we'll be rebuilding and restocking our national petroleum reserves. So that will take away some of the extra production, or I guess be a use for the extra production. But also one thing that was noted both in the U.S. but particularly internationally, last year was a mild winter globally. And this year, as we know in the US, but also more just internationally, it's a lot colder. So, I mean, I think some of these recent, because energy related orders um, will actually help our potentially also help our exports. I mean, we're already, I think we covered this a number of quarters ago about I guess we've become more energy independent,
Hmm.
um, increasingly so over the years. But as far as an export, in addition to increasing production, we may also, especially given the colder winter internationally, be increasing our exports. So it may help from a trade perspective, trade balance perspective as well. So we'll see.
Interesting you mentioned the Paris Accord. When you look at our contribution to like global carbon, we're like one of the lowest. Additionally, these policies are typically implemented by the private sector. So companies are interested in being green and having a green profile, and they make those decisions to have a green building or solar panels or, whatever it may be to manage their own energy. But I don't have any concerns about us leaving, for example, the Paris Accord, because when you look at our contribution to carbon and our trend line has gone down. We've converted a lot of our um, energy areas from coal to natural gas, and so it's lowered our carbon footprint tremendously. Okay. Job openings, we did that. Uh, what is your view regarding the economic impact on AI? So this one's interesting because it's a dual fold, which is that it will grow the economy because it will grow the top 10 or the magnificent seven companies. There's a lot of money being invested and companies that are going to engage the Microsoft and um, NVIDIA companies of the world, but there's also going to be some labor that's lost as a result because, ChatGPT can do things that, otherwise a person they'll won't hire someone to do. So there's a dual fold. I think it will ultimately have a net positive because the amount of investment that's being made and the amount that people are going to pay for the AI is ultimately going to be a positive more than the jobs that are lost as a result. Right now, we're seeing the valuations be so high because there's so much euphoria about it. So that's part of where we're seeing. Brian alluded to this deep sea AI, which is out of China, that NVIDIA went down 17% on Monday, just like that. And so there are some valuations that can be concerning based on how excited people are about AI. And that's definitely on our radar. But ultimately, long term, of course, see it's going to be a positive. Brian, how do you view this
I
question?
mean, overall, I think it'd be a positive, but there are, I mean, I think like the deep sea will make folks incident from this, I guess, or declaration as that more needs to be dug into it. I know some companies have responded to it already, but um, that may force some companies to reevaluate their spending in the AI area because I know some companies are looking, to utilize AI and may reconsider how much you're putting in towards AI. I mean, a lot of the AI, industries, other industries, not necessarily talking about like the chips and stuff, the people that make the AI happen, but the users of it. There's all the rest of the industries are still trying to figure out how can they leverage AI. But I agree also to Chris's point. I don't this I mean, while it will replace, maybe make some companies more efficient, I don't see it being like this act this event or this activity or this feature that reduces payroll, reduces employment substantially. I mean, it's just basically kind of leveraging and making things more efficient and people more productive, but not necessarily resulting in large labor cuts, but so to speak.
it- to expand on your point, the other sort of byproduct of all this AI are utilities, because there's a lot of electricity that goes into these server farms, and the electricity demand is quite high. So there are other components to the economy that are benefiting other than just the tech companies themselves. And so yeah, and so we factor that in as well. Okay, next question. How will renewing the tax cut affect the US economy and the national debt going forward? Would the economy be better off not renewing the cuts? So that's a tough one, because going back to the deficit, there's this term called the Laffer curve. Art Laffer won the Nobel Prize for his um, analysis on taxes. And basically, it looks like a semicircle like this. And this semicircle, the top of the semicircle represents total tax revenue. And so on this side, you have zero tax, but you have zero tax revenue because you're not taxing anything. And then you have this arc, and then it ends here on the far other side, which if you have 100% tax revenue, you have zero tax income because no one's going to do anything. If you tax 100%, you're going to get nothing. No one's going to produce anything. So there's this metric that says, well, if you tax 80%, you're going to slow the economy. If you tax 70%, you're going to slow the economy. If you tax 10, 20, 15%, you're not going to bring in enough, and you'll keep running a deficit. So it's tough to say, because the academics would say, Jerry, to your point, it's going to get worse. We're going to have a greater deficit and things will get worse. And what this administration is looking to suggest is that by being more business friendly, reducing taxes, we will grow the economy. And by growing the economy, we will collect more tax revenue, because we would have taken this sort of Laffer curve concept, and maybe we would get more tax revenue by lowering the tax. It's to be determined. And then so trying to think of where's our other slide on the budget. Get
The
down here.
income. Yeah.
Department of Government Efficiency. I mean, are they going to find $1 trillion in stuff? Maybe. I mean, we'll see. So our deficit here is, just under $2 trillion. I think there's, good intentions there. I would hope there would be good intentions, that if they can find fluff or unnecessary spending and we can cut this down by some amount, that'd be a good thing. Are there other areas to cut? Is there a ton of waste in this area? I don't think there's that much, but I mean, we've always said that there's some waste in Medicare, some waste in Medicaid, but I don't know that we're going to cut defense. So I'm sort of talking out of both sides of my mouth, I guess, but we'll see. It's yet to be determined. I think that they're intending to cut taxes and grow the economy. That's their plan. As we continue to host this call, I mean, we have all this data. We'll continue to share it with you. We'll see. We'll see if they're able to grow the economy by cutting taxes. The academics would suggest that cutting the taxes would grow the deficit. But I'd love for the academics to be wrong. Okay. Okay, good point. Forecast for Brent crude in the next 2 years is to decline. Hence, some of the offshore projects that energy companies want to develop may not be profitable. So we may, so for the folks here in Houston, they tend to not have an issue when energy prices are high or gasoline prices are high because that's job security in the energy industry. And when you have this drill baby drill, that's going to lower the price, which most people not in Houston are happy to have lower gasoline prices, but it creates more pressure for the big energy companies. Okay. Close to that time. At the end here, there is 3 or 4 questions. It'll take you not even 30 seconds to answer. Please give us your feedback. So don't necessarily close out the screen. It'll pop up. Give us your feedback. We always like to improve this call. Let me know, let us know what you liked, how you think we can improve, and we'll pick it up here in a couple of months, 3 months from now. Thank you so much. Talk to you later. Bye-bye.